Saudi Arabia is now said to have begun that sale of 5, 10, and 30-year bonds. So how much of an appetite will there be from investors? Joining us now from London is Ahmed Mostaq. He is a strategist for Eclectic Strategy. And I really note here that oil is going north today. It's going up. Play through for me, if you would, Ahmed, the relationship between the price of oil and the price of these bonds. Who's zooming whom, to quote Aretha Franklin?
I think that ultimately, the price of these bonds will only be affected if the oil price moves perhaps 20% in either direction. Because on a day-to-day basis, people are looking forward 5, 10, 30 years. They're asking, is this a new sustainable path for Saudi Arabia to take in terms of its reforms, getting these in place to build a yield curve? They're not looking at, is Saudi Arabia in trouble next year or the year after? I think everyone understands that Saudi Arabia is okay for a few years from here, especially if they get these in place.
Ahmed, a few years is one thing. Would you want to buy 30-year paper and hold to maturity?
I'm very bullish on oil, so I think, yeah.
What have they got to pay up for this? The initial pricing looks like 185 over benchmark. Qatar got away with 150. What do you make of that? The difference between what the Saudis could potentially pay to get this away and what Qatar did. Did the Saudis miss the boat to some extent? Did they not go early enough?
I think they probably should have gone earlier because ultimately Saudi Arabia hasn't got a developed yield curve yet, and this is the first stage in that. As was noted a bit earlier in the show, Saudi Arabia probably needs to raise another $30 billion a year or so if they're going to hit that debt to GDP target on a $300 billion GDP. What this will do is it will set a benchmark, and then we'll see how these bonds trade, because you can't price Saudi Arabian paper in isolation. So the market had to take the Qatari price and then factor in the fact that Saudi Arabia is one notch lower. There's simply no other metric to go with. And going forward, you'll see Saudi corporates also pricing off the new sovereign curve.
So Ahmad, talk to us about demand. So Qatar was going to come in with $5 billion. It went up to $9 billion. Saudis are looking to issue maybe $10 billion. What is that number actually going to be?
I wouldn't be surprised to see 15 billion. Actually, it's quite interesting because if you look at the OPEC freeze/cut, if Saudi Arabia reduces 500,000 barrels a day of production over the next year, as the market anticipates, at $50 oil, that's $9 billion in lost revenue. At 0.75 million barrels per day, that's $14 billion in lost revenue. So it actually matches the current issuance quite well. They're effectively borrowing to fund their production cut.
That's a great way of looking at it. So what does that wind up meaning for issuance going forward?
Well, like I said, if you look at Saudi Arabia's targets for net debt to GDP, they are looking at around about $30 billion next year until 2020. I think they will keenly watch how this bond moves, especially in the wake of where oil prices go over the next year, before figuring out a strategy for issuing further bonds. But clearly, with the deficit where it is, they need to have additional liquidity within the system, and they want it from as many sources as possible, because ultimately, they've still got like $80 billion of short-term treasuries in the US. They have the cash, they just want to try and get sustainable systems in place in case they really need them.
So Ahmed, who's next up? Is it Saudi coming back? Is it Jordan? Is it Kuwait? Who's next up?
I would say probably Jordan will probably pip Kuwait. Jordan's in far more need of a bond issuance than Kuwait, which again really needs to just formulate its yield curve. If you look at Kuwait, they're going to return to a current account surplus next year, whereas Jordan, absent external support, the economy looks very shaky there. But that's a completely different story in terms of economic structure to the Gulf majors.
Well, I was going to say it's very different. They don't have the oil. So the pricing is going to be very different for a Jordan.
Yeah, again, I think that if you look at Jordan, as you said, it doesn't have oil. The price is going to be a very different story. But debt capital markets in the whole Middle East have been very, very thin for many years, apart from Dubai. This is all very positive because the more data points we have, the more the market can actually figure out how to trade these appropriately and how to price these appropriately. Like a country like Qatar shouldn't be pricing so wide, in my opinion, because ultimately, if you look at their cash versus their obligations, they're about as secure as you can get. Saudi Arabia has more obligations, and so they do need to do these reforms. But again, I wouldn't be surprised to see some of these spreads tighten as you get more information.
And what happens to the banks in Saudi Arabia? Do they get more cash? Are they able to issue more?
Yeah, I mean, Saudi Arabia has recently done a $5.8 billion liquidity injection into the banks. But what you're seeing at the moment is capital flight out of the banking sector. We saw in the recent NCB, one of the largest banks in Saudi Arabia, deposit numbers being down year on year significantly. Saudi Arabia basically, again, needs to put in the procedures and the processes in place to have a stable, fully functioning, independent economy. This involves independent yield curves. It involves being able to tap every single source of capital markets possible. As you get more of these in place and you go through the difficult part of reform, people will be encouraged to put money back into Saudi Arabia, especially if their reform plans come to fruition.